Hey, folks, two very quick announcements before I get started. One is some of you might have gotten emailed this morning about your company not being on the master list. So I did go through the master list, and you've all told me you've already picked a company. So I'm sure this is just an oversight. So there are like 20 people without company names. I just sent an email out saying, I'm sure you've just forgotten to do this. But if you're having trouble getting on the master list, let me know, because if you don't have a Stern email address, it won't even let you get on the Google shared sheet. And so you got to find your Stern email address. Second announcement is about the quiz, which is a week from today. It's in the first 30 minutes of class. I want to be very clear. So if you're going to be late, that's not the day to be late on, because that'll mean a big chunk of the quiz goes by. It'll be open book, open notes, but open notes in the 2025 version of open notes, digital iPad, you know. So you can even open your laptop if that's where you have your slides. You just can't open up Excel and work on it. Not because Excel's going to help you that much, but because I can't have 200 computers all trying to juggle for time and space and making noises. So it's open book, open notes, and it'll be, you just write your answers on the quiz. And if you've looked at past quizzes, you know exactly what the quiz will look like, right? So there'll be no surprises, no need to memorize equations, but you do need, but don't assume because it's open book, open notes that you can come to the quiz and look for things. 30 minutes is not a long time. So if you're looking for a page in the lecture notes because you don't even know what the topic is, you will never finish, right? There is no time crunch, to the extent that, I mean, I've tested the quiz out and on the TAs, I've tried it out myself. So basically we double the time and see if in fact you can get through. So there shouldn't be a time crunch, but that doesn't mean that if you're looking up stuff that you will not have a time crunch. Any questions about the quiz? Okay. So the quiz will be the first 30 minutes, and then the quizzes will get sorted, and then I'll let you in on what happens in terms of the logistics after that. So today we're going to start on our journey, because this process of looking at risk-free rates and betas and equity risk premiums was to get to a hurdle rate, right? A number. So today I want to bring them all into completion. So we start with the risk-free rate, right? Leon, remind me again how you come up with the risk-free rate. Uh, Depends on the currency you pick. If it's US dollars, you might pick the treasury and hope and pray the US treasury is not default free. If it's some other currency, you might have work to do. The risk-free rate is in the currency of your choice. The equity risk premium reflects where you do business, right? So if you're in, doesn't matter where you're incorporated. And the beta, up till now at least, at least in an unsatisfying way, we came up with by running a regression. The slope of the line was the beta. For the moment, let's stay with that beta, even though it doesn't seem like a great way of estimating what the beta of a company should be. So for Disney in November of 2013, here's what the numbers look like. First, if you look at the risk-free rate, 2.75%, the US 10-year T-bond rate in November of 2013. As I do this calculation, in your head, I want you to think about what those numbers would look like if you did them today, right? T-bond rate then was 2.75%. The equity risk premium reflecting where Disney did business. Remember, 82% in the US, 18% of the rest of the world, was 5.76%. And the regression beta was 1.25. Let's put all the numbers together. Risk-free rate plus beta times equity risk premium gives me a cost of equity or an expected return of 9.95%. This is something you do ad nauseum in any foundations class, risk-free rate. I want to put some flesh on this number. Okay? So here's the first thing I want you to think about. Let's suppose we've all gathered together, we've done the number crunching, we've come up with 9.95%. You are potential investors in Disney. So you're a potential investor in Disney. It's November of 2013. I want you to tell me what the 9.95% will tell you as an investor. So as I read these statements, if that is the statement that you would agree with, just pick that. 9.95% of the return I can expect to make in the long term on Disney if the stock is correctly priced and the CAPM is the right model for risk. How many qualifiers did I put in there? Let's go through. It's expected. So no guarantees in the long term. So don't come to me next year and say I didn't make 9.95%. If the stock is correctly priced, if stocks are mispriced, all bets are off, and the CAPM is the right model for risk. When I add this, I'm a lazy person. When I'm adding this many qualifiers, you know why I'm doing it, right? Because I want to get to a true statement. So that, in fact, is one way of describing the 9.95%. But it's a very, it's an unsatisfying way because if you add all these qualifiers, that's a return. So let me give you another statement. You tell me whether this is something you might agree with as well. Right? 9.95% is the return I need to make on Disney as an investor to break even on my investment. It sounds like I'm getting greedy, right? You're saying, why 9.95%? Why not just the risk free rate? Why not just the risk free rate, Derek? Why do I need to make 9.95% to break even? The risk free rate is only 2.75%. You have the added risk, right? If I wanted to make 2.75%, I'd buy a T bond. You made me buy Disney stock. It's riskier. I need to make this return to break even given the risk in the investment. Both these statements are true. The first is how a person in efficient markets, where markets work perfectly, would describe the 9.95%. But if you wanted to take a more activist view of that number, that's the number you need to make. So both statements are true, but very different perspectives. So let's say you decide to do your own research on Disney. You collect the data on the management, the projects, you look at the cash flows, the earnings, and based on your assessment, you think you can make a 12.5% return. Patrick, help me out here. You need to make 9.95% on Disney to break even. You think you can make 12.5%. What does that make Disney? A buy or a sell? A buy, because you can see already that without an expected return, you can't tell me what to buy or sell. The reason I bring that up, and I'm constantly running into equity research analysts who tell me, I don't believe in the CAPM, I don't need an expected return. How the heck do you decide whether a stock is a good investment or a bad investment without a threshold? I'm not stopping you from picking stocks. You can pick stocks. All that the CAPM gives you is the return you need to make to break even. And the riskier an investment, the more I need to do to earn to break even. We're getting closer to a hurdle rate. The regression beta still troubles me, and I'll give you a way around it. But that's why we compute this expected return. So from an investor perspective, you can see why this number matters. It is the number you need to make. But let's look at it from the other side. I'm the CFO of Disney. You're all my potential investors. You need to make 9.95%, not even to be happy, just to break even. You supply what capital to me? Equity or debt? You're buying shares, you're supplying equity. This is now my cost of equity. Your expected return as an investor becomes my cost of equity. You're saying, what if I don't like it? I raised capital from you. If that's your expected return, I need to try to deliver it. Which means if I'm looking at projects at Disney, collectively those projects need to earn a return on the equity I invest in those projects that exceeds 9.95%. You see how we're tiptoeing towards a hurdle rate? The 9.95% becomes a collective hurdle rate for everything put together. Later we'll come back and talk about individual projects, but as a company I need to earn a return on equity that exceeds the 9.95%. A few years ago, I was trying to explain this to a CFO of a family group company in Asia. So I went through a cost of equity calculation, risk-free rate, beta, risk premium, came up with a cost of equity of 14% on one named the currency. And I said, you need to make a return equity collectively as a company that exceeds 14%. And then he asked me a question. I'd like one of you to help me answer the question. He said, what if I don't deliver that 14%? You see, when you borrow money and at 8% you don't deliver the 8%, what happens? You go bankrupt. You get into trouble. His question was, I've raised equity. I know your expected return was 14%, but what if I take 7% projects? Jen, what is your response going to be then? What's the cost of not delivering? Obviously, I don't go bankrupt. So explain to me as a CFO of the company why not making 14% would be a problem for me. There's risk, but in a sense, I've just raised your equity already. I have your money. I'm taking projects that make less than 14%. I'm doing it deliberately. It's not by accident. So tell me what the consequence will be. First, are my shareholders going to be happy with me, or they're going to be pretty pissed off, right? So you're going to try the first thing. Your shareholders be really pissed off, and then what are they going to do? They're going to get together and try to replace you, and I'm going to laugh at you. I'm a CFO of a family group company. There's nothing you can do to me. My last name is the same name as the company's name. If corporate governance is weak, and this is why we spend so much time asking where does the power lie? If you're afraid of shareholders, here's how it plays out. You don't deliver the cost of equity, you don't go bankrupt, but your stock price drops, your shareholders get pissed off at you, and at some point in time, you get replaced. But without that stick, you can already see why in many companies you know the cost of equity, but in a sense, you don't care. You take projects that make less than that, say, I have your money, what are you going to do to me? So as you look at this as a cost of equity, you need that corporate governance push to get companies to try to make more than the cost of equity. Any questions on that? So what I'd like you to do for your company is to print off that beta page from Bloomberg. Okay? Take it through the process I took Disney through. Start with, the intercept. Was your stock a good or a bad investment? I noticed quite a few of you have, I think there are 3 NVIDIAs in this class, I think 5 Chipotles, I can, eating a lot of those, so quite a few Starbucks. Yeah. So it's a very consumer product driven class. I want you to think about, looking at that regression, don't overthink it. It's basically a measure of how well or badly your stock did during the last 2 years, last 5 years. Start with that. Then take the slope of the line. That's a beta. But make sure you check out the standard error of the beta to get a range on it. You are going to use this as your way of getting acquainted with your company. I mean, the analogy I would offer is this is like when you pick a new doctor and they run that panel of blood tests. This is like you're not going to, diagnose the company with anything serious yet, but you're getting acquainted with, hey, was my company a good investment? How does it move with the market? What portion of the risk, the R squared, what portion of the risk comes from the market? How much is company specific? So now let's build on this theme, because if you believe this notion of risk-free rate plus beta times equity risk premium, as my beta increases for the company, it becomes a more risky company. Remember, the risk-free rate and equity risk premium are kind of given. You can't control them. But the beta is going to be a function of what kind of business you're in. Let's say you are a consultant and I am a tech company. I'm a software company. My beta is 2. My beta is actually 3. I'm a very risky software company. So I come to you and say, I need a hurdle rate because I need to decide how to pick projects, what the hurdle rate should be. You put in a beta of 3 into that equation, risk-free rate plus beta times equity risk premium. Not surprisingly, you come up with a really high cost of equity. So you come to me and say, your cost of equity is 20%. We pause right there. As a CFO, does this make my life more difficult or less difficult? Why? Because I have to find projects that make more than 20%. So I come back to you with, I think is a normal question that any CFO is going to answer. What can I do to bring my cost of equity down? And I'm going to argue that at least 3 things you can try to do. They're not all sensible things, but if your objective is to bring your beta down, can somebody give me at least 1, maybe even 2 of those 3 things you can do? What can the company do to reduce its cost of equity? You can always try the cosmetic stuff of getting in front of a Bloomberg, changing the starting and the ending points, try to make, that's not the path I want you to go, right? Unfortunately, that's the path that some CFOs will go because they want to just play games. But let's take that to the side. I want you to do something real to bring the cost of equity down. Yes. One is if I have any debt, would you like me to pay it down or add to the debt? You didn't tell me which. Pay it down. Why? Because when I borrow money, I make my equity riskier, right? Unfortunately, as a software company, what's probably going to be on my balance sheet? Very little debt. So that option is off the table. But if you're a telecom company with a high beta, you might, yes. Diversify your business into other areas that have less risk. Let's take that to the next pragmatic step. To diversify my business, I'm in the software business. I need to find money to invest in other businesses, right? One is I can sell a portion of my software business and buy something safer. By doing that, what do? I reduce the beta of my company. I didn't tell you this was all off in a sense. I could go and become a utility on the side. I'll get a lower beta, but what else comes with that lower beta? Why am I in the software business? Because it has great returns. Danger plus opportunity, right? If I want to lower my beta, I can liquidate the entire business, put all my money in T-bills, become a money market fund. In which case, what's my beta going to be? It's going to be zero, but I'll earn the T-bill rate. So if your end game is reducing risk, you can try that. But there are some creative ways I can stay in the software business and make myself less risky. How many of you are Adobe product users? Acrobat, Dreamweaver. There was a time when I used to have to buy the software every 2 or 3 years. It was a software company that made money with upgrades. You had to pay for upgrades. Now, if you buy an Adobe product, I don't think there's a way you can actually buy Acrobat or Dreamweaver. You got to be, what do you have to do? You have to be a subscriber, a subscription-based model. Already you can see why for a software company, a subscription-based model actually reduces risk, because now you have a model where you get $79.99 every year rather than wait and see if people will upgrade, and to do that they need money. So in a sense, you've made your business less discretionary. So second thing you can do is try to make your business safer by either going into safer businesses or being creative with your existing business and making your revenue streams more predictable. There's a third action you can take. And in a sense, we're laying the foundations for what truly drives beta. If I have a lot of fixed costs as a company, think of what it does to my earnings. It makes my earnings more volatile, right? In good times, I make lots of money. In bad times, I lose a lot. So one of the things you might ask me is, show me your cost structure. What are your biggest fixed costs? And is there a way we can make them variable? What are some of the ways you can take a fixed cost and make it variable? Let's be creative. What could you try? Leasing is still going to be a fixed cost, right? It's a fixed lease cost. But what does outsourcing do? I'm not again suggesting it's a good thing to do. What does outsourcing do? It takes a cost that used to be a fixed cost and makes it a variable cost. Of course, there's a trade-off here. You no longer control the process. You could try outsourcing. You could try for more flexible contracts. So when you negotiate with employees you might offer them higher wages in return for flexibility. If things don't go well, that you can lay off people, reduce your costs. It's a process that for the last 3 decades you've seen at companies in the US and globally trying to make their cost structures more flexible. But the end game here is, if you focus on reducing betas, I can tell you ways of getting there, but you say, should I do that? It's a different question, right? It might be better to stay a high beta company with a high cost of equity and go out and pick the best projects you can. And if you look at the great companies, the companies that are doing well out there in terms of market price, most of them are risky companies. Most of them have unstable, unpredictable earnings, but they're still able to deliver returns that exceed that. So given a choice of being in a risky business and earning high returns in equity, and being in a safer business and ending up with low cost of equity, you might pick the first over the second, because ultimately this is about creating value. Now, before I actually dig a little deeper into what drives betas, I want to complete the beta pages for my other companies. I did Disney in detail, but I won't do the other companies in as much detail because it'll be excruciatingly boring. So what I've done here is taken Tata Motors. Okay? Again, I went to Bloomberg. As I said, Bloomberg is very parochial. It estimates the beta for Tata Motors against the Sensex. And already we're on shakier ground in terms of the index. Why? Because it's not that it's not again that I am when I look at the S&P 500, I'm attached to it as a U.S. index. I'm attached to it because it has 500 companies in the index. There isn't an equivalent index in India that I can latch onto with any history. The Sensex has been around a long time, but it's not a wide, broad index, but we'll take it for what it is. Let's read what the regression tells us. First, if you look at the slope of the line, the raw beta is 1.83. So to the extent that I trust this regression, it's telling me that Tata Motors is 1.83 times more risky than the typical Indian company. But if you bring in the standard error, which is 0.16, the range on that beta is 1.67 to 1.99. 95%, you're going to go to 1.53 to 2.14. So essentially plus or minus two standard errors. If you look at the R squared, 69%. 69% of the risk in Tata Motors comes from the market. The remaining 31% comes from the firm. And again, reminding you what that means. If you diversify, the 31% should go away. The 69% will stay. The Jensen's alpha, the intercept is 2.28. And remember what I said about Bloomberg intercepts. They're pretty sloppy about decimals and percentages. That's 2.28%. You subtract out the risk-free rate, which in Indian rupees was 4% on average. But remember, because it's a monthly regression, I divide by 12 to make it a monthly risk-free rate. The Jensen's alpha I come up with on a monthly basis is 2.56%. That's every month you make 2.56%. On an annual basis, that number is going to become 35.42%. So if I asked you, was Tata Motors a good investment between 2009 and 2013? The answer is absolutely. If you'd owned Tata Motors all the way through, you'd have benefited, but there's no way you can go back in time and make that. But when you see a Jensen's alpha of 35.42%, just like with Disney of 9.02%, it's worth stopping and asking the question, why? What did they do that allowed them to deliver this 35.4%? They might have gotten lucky being in a sector that took off. For Tata Motors, that wasn't the case. The average Jensen's alpha for automobile companies in that period was close to zero. The one action that they took during this period that really made a difference to them was the acquisition they made of Jaguar Land Rover. Now, normally acquisitions are value destructive. It's among the most value destructive things companies do. You saw the Sterling Drugs Eastman Kodak acquisition. You're saying what made the Tata Motors acquisition of Jaguar Land Rover pay off so well? First, in an acquisition, it's nice to find the right seller. You know who owned Jaguar Land Rover in 2009? Who did Tata Motors buy Jaguar Land Rover from? They bought it from Ford. Ford in 2009 was desperate to get rid of stuff off their balance sheet. Why? Because you'd come out the 2008 crisis. GM had already gone under. Ford was on its way. They said, we want to get rid of Jaguar Land Rover at any price. If you're ever going to buy something, find somebody who says, I will sell it to you at any price. And take them up on their word, because they effectively gave away Jaguar Land Rover for a song. Tata Motors has been saved by that acquisition ever since. And you saw in the first 5 years the payoff from having bought Jaguar Land Rover at a really low price. It's not that they bought Jaguar Land Rover per se, but that they bought it at a really low price. So when you do this for your company and you end up with a really big positive Jensen's alpha or a big negative Jensen's alpha, don't think of it just as a number. Do a little digging to see what might have caused it. So if you're doing Starbucks, what do you think the Jensen's alpha is going to look like for Starbucks right now? I mean, you're reading the news stories. It's a company with a broken story, right? It's a company that is in trouble. How do we know it's in trouble? It's had, what, two CEOs kind of rotate through, a new CEO, the Chipotle guy is now in charge. Clearly something is broken in the model. And if any of you get a Starbucks, you can see what's broken every time you walk into a Starbucks, right? I haven't stood in line to order a Starbucks in forever because I ordered online. And when you go and what do you see? You see 50 people waiting for their online pickup orders and two forlorn people sitting in the Starbucks. For which Starbucks pays how much for those stores? The original Howard Schultz idea of Starbucks being a cafe where people gathered and ordered customized drinks and had a good time, it's kind of broken. And I'm not sure how you bring it back together. And the market recognizes that. So if you look at the last 5 years, you're probably going to get a negative Jensen's alpha, and there you're going to talk about what's so. With all of these things, and not just in this part, whenever you get a number, don't stop at the number. Dig a little deeper and give it some flavor by looking at what's causing the number to be what it is. Finally, I decided to get an expected return in rupees. Why? Because I wanted to. I wanted to do everything in rupees. And if I do everything in rupees, I need a risk-free rate in rupees. I know it's been a while and you probably don't recognize the 6.57%. But my risk-free rate in rupees is not the Indian government bond rate, which was 8.82%. It was that number minus the default spread. And you're going to see in a minute why I need to do that. I end up with a risk-free rate in rupees of 6.57%. The beta, at least if I trust this regression, is 1.83. And the equity risk premium is the weighted average equity risk premium of the parts of the world that Tata Motors operates in. And remember, China and India are very close to each other, 23.6 versus 23.9%. Again, the same template that I'm using for Disney. What does that mean? If I buy Tata Motors as an investor, as a potential investor, I need to make 19.73% to break even in rupee terms. Could I have done this entirely in US dollars? In which case, what would be different? First, if I do the risk-free rate, it has to be the UST bond rate, right? Which would be much lower. I'd get a lower expected return in Indian rupee, in US dollars than in Indian rupees because I'm working with a lower inflation currency. And if you are intimidated by the 19.73%, estimate the expected return for a Turkish company in Turkish lira. Your required return will be 30, 31, 32%. Not because you're greedy, but if you start with 16, 18% inflation, you need to make 30% just to break even. So that's a Tata Motors calculation. Any questions? Yes. Yeah. The company has the CFO weighted average between the cost of equity and we'll come to that, right? That's basically if all here we're just focused on beta and cost of equity. But you're raising an interesting point. Your end game as a business is to not minimize your cost of equity, but your cost of capital. And I think you're raising an interesting point of if I take away all debt, my cost of equity will be lower, but my cost of capital might end up being higher because I've replaced cheaper debt with more expensive equity. So that's why I said each of the pathways I'm suggesting here is not exactly the way I would suggest they go. But when companies get entirely focused on minimizing their beta, they're going to do exactly what we described, right? You're going to try to focus in on just the equity. It's not good for the company, but you can see why that focus drives your decisions. Let's take Vale. Vale had two choices. I could run the regression with Vale, the domestic listing in Brazil, in which case, regression is against the Bovespa, right? And the beta that you get is about it's less than 1, at 0.89. Or I could take an ADR. ADRs, as I said, are listings of foreign stocks in the US where everything is in dollars. It's easier to trade if you're a non-Brazilian investor to buy the ADR. And if you ask for a regression beta for an ADR, Bloomberg being Bloomberg says it's a US listing. We're going to run it against the S&P 500, and the beta that I get is 1.37. Now, the amount of angst people get when they get these two betas, which one should I use? No. I think Shai here. Shai actually ran the regression against the S&P 500 and the MSCI, and he said, which one? And the answer is they're both crappy numbers, right? They have big standard errors. I can give you pluses and minuses. Again, I'm digging that hole for regression betas even deeper, right? I can run this against two indices. I get different betas. I don't trust either of them. But you're going to get very different regression diagnostics if you pick one of these regressions. So if you're doing a company like Vale where you have multiple listings, pick one. Now, maybe pick the domestic listing, do the regression diagnostics, holding your nose while you do it, because you say, I don't trust this number, I don't trust this number, I don't trust this number. You're right, I don't trust the number either. So we'll talk about replacing the regression beta, but it kind of gives you insight. into how your choices can drive what you end up seeing as the beta for your company. For Deutsche, I actually ran a regression against the DAX. That was the default. But then I reran the regression against the FTSE. Why? Because this is in 1999. In 1999, German investors invest in German stocks, French stocks. With the EU, basically already have investors investing across borders. You could argue that no European stock should have a regression against a domestic index. At least in the US, there are a lot of US domestic investors who invest only in US companies. But in Europe, increasingly, you're investing across the Eurozone. But you can see very different numbers for the intercept and the beta. And for Baidu, I ran the regression against the S&P 500 because it is a NASDAQ listed stock. But the truth is, if there had been a Chinese listing and I'd run it against the Shenzhen, I'd have got a very different number. I did run a regression against the NASDAQ using I think a logic that you will see some analysts use. It's listed on the NASDAQ, so why not regress it against the NASDAQ? The problem, though, is when you regress it against the NASDAQ, what you're getting is a regression against a tech index. The nature of beta shouldn't be against your sector, it should be against the entire market. Part of the reason we stay with the S&P 500, even though we might be looking at a Google or a Microsoft, which might be NASDAQ listed stocks, is because the NASDAQ is almost entirely a tech index. You want broad indices to keep with the tenor of what you're trying to estimate, which is what is the risk added to a diversified portfolio. So now I'm going to return to what we started with at the start of the session. Now, when we started with betas, I made it look like a statistical number, right? Run a regression, the slope of the line is a beta, because that's how I was taught betas. I want to step back because we've already started that process with that example of a beta of 3, and what do you do? And look at what it is that drives betas. And I'm going to use 5 companies, and this example is dated because some of these companies have moved on, they've shifted. But with each company, I want you to stop and think about why the company has the beta that it does, not using a statistical rationale, but an economic one. So let's start at the top, Bulgari. Why do you think Bulgari is such a high beta? What does Bulgari make? Things that none of us needs or wants, but we feel the urge to buy it because we have a lot of money. It is a luxury product that you buy because you're feeling flush with cash. It is an ultimate discretion. You're going to see this word. It is a very discretionary product. And when you have a very discretionary product, in good times, you sell a lot. In bad times, people go to Canal Street and buy a knockoff. Your revenues drop through the floor. You'd expect it to have a high beta because of what it does. Quest Communications, telecom companies. Telecom companies tend to have high betas. But it's not for the same reason that Bulgari does, right? Because let's face it, telecom services are pretty non-discretionary, at least at this point in time. We need the Wi-Fi, we need our cell service. But telecom companies have 2 things working against them that push their betas up. What's the first? But technology you got to invest in that technology. There's a big infrastructure investment, lots of fixed costs, right? Those big cell towers, the cost tens of millions, hundreds of millions, not to, and with all the regulatory costs you got to cover. So lots of fixed costs. And on top of that, what do they have that they've added to those fixed costs? How do most telecom companies fund themselves? With a lot of debt. I have never understood this. Actually, I do. But they borrow money and they add on top of the fixed costs, which kind of violates that principle. You have a lot of fixed costs, don't add to those fixed costs. You're saying, why did they do it? Because AT&T did it 100 years ago. But there's a difference between AT&T borrowing money to buy the original phone infrastructure in the early part of the 1900s and telecom companies today putting up towers. And what's that big difference between, why was AT&T able to get away borrowing money on top of fixed costs? Kelly, what was AT&T building into that allowed them to do it? In fact, Congress actually helped them out. They made them a monopoly. In fact, one of the first law in the 1916, Congress actually effectively gave Marbell the monopoly. So you were building into a monopoly. So you see the advantage of building into a monopoly? You have lots of fixed costs and a lot of debt. But what you're planning to do is you're going to pass it on to customers. AT&T was building into a monopoly. It borrowed money and was able to get away with it. Do you think Verizon is building into a monopoly? Verizon is actually in a technology business where tomorrow Starlink or some satellite-based system could take away their entire business. So what does that mean? If you're a telecom company today, living in the world you're in with the competition you have, you shouldn't be borrowing money. You're saying, but they do. They do. Because that's what's always been done. And this is why I want you to look at your company and say, that doesn't make sense. And don't let yourself say, I'm not a finance person. You don't have to be a finance person. Know that if you have a lot of fixed costs and you put a lot of debt on top of it, and you're building products into a competitive marketplace, you're in a sense asking for trouble. Airlines have the same problem. They have a lot of fixed costs. They borrow money on top of that. Maybe there's time to revamp how these businesses are funded because they might be doing the wrong things given their risk profile. Microsoft. And I did the beta of 1.25. And this was before the cloud business and before the AI business. I've been tracking Microsoft's beta since 1986. When it started, small application software company fighting against a giant IBM. We didn't know whether it had a really high beta. What's changed? First, its product base has widened, right? With Windows, it's got Office, its clients are now much broader than they used to be, consumers, businesses. And the second thing that Microsoft had done was that it accumulated immense amounts of cash. You're saying, why does that matter? What's the beta of cash? Zero. So as a company, as you accumulate cash, it almost acts like an anchor on your beta, pulling your beta down. So as companies accumulate large amounts of cash, and many of these technology companies are 80% technology, 20% cash. That cash operates as a factor pulling the betas down. And this was the old GE, not the zombie GE that you see around. This was GE at its peak. You know what businesses GE was in? Actually, a question you have to ask is what businesses was it not in? It was in like 26 different businesses, appliances, aircraft, services, capital. It's a classic conglomerate, right? What should the beta of a conglomerate converge towards? It should be towards a market. The beta should move towards 1. The only reason GE's beta stayed above 1 is the biggest part of GE for much of its glorious life was GE Capital between 1986. That was a big bet Jack Welch made. You think, so what? GE Capital brought a lot of debt into the process. That debt operated as a ballast, pushing the beta up. Keep going. ExxonMobil beta 0.70. You think oil company, you think lots of risk, right? But what's the risk that ExxonMobil is most exposed to? It's the only risk, actually, is what happens to oil prices, right? ExxonMobil, if you ask me who the CEO of ExxonMobil is, my response is I don't know and I don't care. You're making a bet on oil, on ExxonMobil. You're saying, but that's risky. So when oil prices go up, ExxonMobil's earnings go up, and oil prices go down, that should make it risky. But remember, beta measures risk added to the market. If as oil prices go up, oil companies do well, what happens to airlines when oil prices go up? They get squeezed. There are big chunks of the market where oil is a cost, not a revenue. So if your biggest risk is moving in the opposite direction as the rest of the market, you could end up with a low beta, or you could even end up with a negative beta. This is every investment banker's favorite question for MBA. So let's play it through. Can a beta be negative? Yes. And it's kind of mind-boggling, right? If a beta is negative, what happens to the expected return on the stock? Risk-free rate plus beta times equity risk premium, right? You put in a negative beta, your expected return is going to be lower than the risk-free rate. So why would I invest in a stock or in any investment and earn less than the expected return? There are very few companies on the S&P on the U.S. exchange with negative betas. The ones that used to exist used to be gold mining companies. What is it about gold and gold mining that might lead you as an investor to buy stock in that company even though the expected return is less than the risk-free rate?
Hedge against inflation.
It's insurance, right? The key word is you buy insurance. What does that mean? I'm going to ask you to pay a price. You want insurance. It's insurance against inflation. You want that insurance if the bulk of your portfolio is in financial assets and you buy gold or gold mining stocks, you're buying insurance against inflation. And the way it's going to cost you is you settle for an expected return that's less than the risk-free rate. There are people out there who believe in gold as an investment passionately. And that's a problem because they don't just want you to add gold to a portfolio. What do they want you to do? Sell everything and buy gold. It's a horrifically bad investment in the long term. Over the last 350 years, and we have gold prices going that long, the expected return on gold has been about 2 to 3%, roughly the inflation rate. You're saying that's terrible. Not if you have it as an add-on investment, but if all your money is invested in gold, I can safely predict that 60 years from now you're going to look back and say, I wish I hadn't done that. But by then it's going to be too late. So if any of your relatives are gold bugs, listen to them, but don't act on what they ask you to do. Because they're very paranoid people. They're convinced that the world is ending any moment now. But if you have Bitcoin enthusiasts, they're not that different either. Bitcoin is just millennial gold. So basically, let them talk to each other. Now, maybe they can convince each other to take half the money in gold and half in Bitcoin. So when you think about beta, think of it as added risk, and you can see the pieces come into play. So let's pull together the pieces that drive beta. First is, you tell me what you do as a company. I can already start to guess whether you should have a high beta or low beta. So you picked a company, right? What's your company? Chevron. Discretionary, non-discretionary. You get the car out there. You better not be discretionary. Right? You don't fill the gas tank up. You said Chevron, right? Yeah. I'm going to need the gas, right? Maybe if I have an electric car, I don't, but the power that powers the electric car has to come from a power station somewhere, which is probably also fossil fuel driven. Let's face it, we might bitch and moan about fossil fuel companies. We say they're terrible companies, but they're going to have low betas. Who are you doing, Leon? ADP. That's interesting. What does ADP do? It's a business services company, right? In fact, if they stop doing it, your paychecks won't go out, your internal processes break down. As a business product, it's pretty non-discretionary. You're not going to cut your ADP services if you're in trouble. You might cut off those other things that you do. Gain low beta. Who are you doing? What do they do? I've never heard of them. Interesting company. There must be a reason you picked it. Now we're into questions like, is gaming a discretionary product or a non-discretionary product? I know many of you have DraftKings on your phone. And you're going to skip your grocery bill some weeks so that you can keep betting on DraftKings. So it's an interesting question. Is gaming but that's the question you need to ask. What does my company do? Is it discretionary, non-discretionary? Because that's going to determine whether your company will have a high, an average, or a low beta. Now, and there's one sector I think brings home this concept very simply. You take the retail sector. You got luxury retail, you got department stores, you got discount retail, you got grocery retail. I'll let you kind of think about the ranking. Think about discretionary, non-discretionary. You can already see the ranking you should get across those companies. Now, staying on that concept of discretionary, and this might be a terrible example because phone service now across the globe has become smartphones. But if you go back before smartphones, there was a time when phone service in much of the West was non-discretionary. In the US, in some states, you had to get a phone so you could call emergency services if you needed it. But in much of the rest of the world, it was still very discretionary. When at one point in time, less than 5% of people in India own phones. The other 5% been waiting for 10 years to get a phone, but that's a different point. The remaining 90% couldn't even afford a phone. You see why this makes it discretionary? If India does well, there's lots of growth, a lot more people become, move up from to have enough income. And the bottom line of this is if I compare the betas of telecom companies in developed markets to emerging markets, what should I expect to see? Which group should have the higher beta if you accept that starting premise of it being discretionary in emerging markets and non-discretionary in developed markets? You'd expect the beta for telecom companies in emerging markets to be higher. If you go to my webpage, and we'll talk about using this, I report betas by business. I do a global beta, I do US betas, I do European betas, I do emerging market betas. And for the most part, I go with global betas. I'll talk about why. But if you have a business where you look at the business and say, you know what, in the emerging market I'm looking at, this is not a non-discretionary product. It's a very discretionary product. The emerging market betas might fit you better because they capture the nature of the product in that. So already I want you to stop thinking about regression betas and start thinking about products and services. What does my business do? And if you're actually thinking about running this company better, you might say, what can I do to make this product less discretionary? The subscription model, something to make your product sticky so people keep coming back even in bad times. Second stop, tell me something about your cost structure. I started this idea with the example we had. When you look at the cost for a company, some costs are fixed costs. And some costs are directly related to what you sell, variable costs. If most of your costs are fixed costs, you have high operating leverage. If most of your costs are variable costs, you have low operating leverage. Why does it matter? If you have lots of fixed costs, again, it just makes your earnings more volatile because you've got to cover that cost structure. The problem, of course, is measuring fixed and variable costs, looking at financial statements is tough to do, but generically, at least, you'd expect sectors with high operating leverage to have higher betas than sectors with low operating leverage. I'll give you my favorite example of a sector which is burdened by so much in fixed cost that it never has a normal year. It's either going bankrupt or making billions. It's the airline business. Think of the cost structure for an airline. What's the biggest single expense? Leasing the aircraft, right? You got to pay for that. On top of that, you have fuel costs. And if you're a unionized airline, you've got employee costs, which are fixed as well. Fixed, fixed, fixed. 90%, 95% of your costs are fixed costs. So when you have good times, you make lots of money. In bad times, you're going to go bankrupt. But even within the airline business, there's an outlier, right? It's the most written about written about company in case studies ever. Who am I talking about? Southwest, the template for the discount airline. Until Southwest came along, there were no discount airlines. So let's think about the Southwest model. Does it lease its aircraft? Yeah, like every other airline. But for the longest time, every Southwest aircraft was a Boeing 737. You know why they leased the exact same aircraft? Because it meant less maintenance crews, less spare. They were thinking in terms of keeping their fixed costs low. Fuel costs? I hope Southwest is not economizing on fuel because I do fly Southwest sometimes. But they're one of two airlines in the world, the other is Singapore Air, that consistently hedges against fuel prices. Consistently. You think, what do the other airlines do? They hedge at exactly the wrong times. They start hedging when oil prices peak and they stop hedging when but Southwest does it all the time. What does that give them? It gives them more predictable costs, which is one reason Southwest ticket prices don't swing around like United ticket prices. It's a fixed cost, but they've kind of built it into their systems, the ticket prices carry it. Are they a unionized airline? Yeah. But they've got the most flexible workforce ever. If you've ever taken a Southwest flight, I think every attendant is also a part-time comedian. Maybe if they bring a guitar, they'll be stringing music along in case you don't have entertainment. It's the only airline where a stewardess has checked me onto a flight. Try that with United. You could be surrounded by 20 stewardesses, and they say, I can't do that. I've never done that before. It's, but here's the biggest savings you get if you're Southwest. For the longest time, and this is starting to change, if you took a Southwest flight out of New York, I remember taking a Southwest flight out of New York, this is 20 years ago. Um, Ticket prices were cheap. I get the ticket the day of the flight. I check my ticket to see which airport I'm flying out of. Is it JFK? Is it Newark? Is it LaGuardia? And it says Islip. So, uh, no insult meant to people who grew up in Islip. I had no idea where Islip was. This is a town in Long Island. I get into a cab, say, take me to Islip. He has no idea where to go, so we kind of navigate our way. We get there. It's a tiny little airport. I get on a flight, say, thank you, God, I made that flight. And I'm flying into LA, and I'm thinking I'm going to land in LAX. I land, and I come out. There's a huge statue of John Wayne in the middle of the airport. I'm in Santa Ana. For the longest time, if you took Southwest flights, they avoided the big name airports, right? No hair, Midway. What was their rationale for doing this? How does United control Terminal C and now Terminal A? Like 150 gates. I think they partly control it for the laughs. They fly you into gate 35 and give you a connecting flight in 143. There's somebody upstairs watching you on a camera and says, she won't make it. Let's switch the signs on her. It's like comedy acts. But the way they keep those gates is they have to pay for those gates, whether one flight goes out of 15. It's a fixed cost. The original reason Southwest avoided the big airports is Islip paid Southwest to fly out of Islip rather than the other way around. It's a tactic that European discount airlines have adopted, right? So for God's sakes, don't take a European discount airline to Paris. You will land somewhere within 120 miles of Paris. It'll be some airport somewhere, really low fare, but then you got to figure out a way how to get to Paris. Every action that Southwest has taken through its life has been about keeping fixed costs low. And you know how it paid off? After 9/11, there was a point in time when Southwest Airlines alone was worth more than every other airline put together. So when you think about fixed costs, that's basically what you're talking about. But is there a trade-off here, though? Southwest lose some revenue because they fly out of Islip? Absolutely. They probably also lose those revenues from connecting flights coming through. And they were willing to accept it. So I'm not saying this is a freebie. When you go for less fixed costs, you're adopting a different business model, but you're also giving up revenues. So with that in place, though, if you ask me to measure the operating leverage in a company, I'm going to run into a problem. For the company you take their most recent financial statement, their income statement, and I challenge you to tell me which of the costs you see in that statement are fixed and which are variable. Let's go through a typical income statement. Starts with revenues, and below that is cost of goods sold, right? Let's make a guess, fixed or variable? Probably variable because it's directly related. And then all bets are off because once you go below gross profit, you have items like SG&A, fixed or variable. Who really knows? You can make a guess and say mostly fixed, mostly variable. The information in financial statements is not good in terms of what's fixed and what's variable. So I'll give you a little trick that might or might not work with your company to figure out whether it has high operating leverage or low operating leverage. Remember what you said happens when you have high operating leverage, lots of fixed costs? When your revenues go up a little, your income goes up a lot. When your revenues drop a little, your income drops a lot. So when Delta lost 3% of its revenues, it was a 45% drop in operating profit. So if you can take the percentage change in operating income and divide it by the percentage change in revenues, you're getting a rough proxy for, does my company have a lot of fixed cost or does it have a lot of variable costs? If that number is a high number, percentage change in operating income is large relative to the percentage change in revenues, you have a company with lots of fixed costs, high operating leverage. And this, you can, don't do it for 1 year because God only knows what 1 year will deliver. But if you do it over enough time, don't get, I know it's intimidating with that many numbers. But what I did for Disney is I went back to 1987 and every year I computed the percentage change in revenues and the percentage change in operating income. Across the entire time period, if you take the percentage change in operating income and divide by the percent change in revenues, the number I get is 1.01. In 1996, though, Disney did buy Cap Cities. It changed its entire makeup as a company. So since 1996, that number is, your first reaction when you look at those numbers is, I don't know whether it's high, whether that's low, whether that's typical. So I computed that number for all entertainment companies. So let's take the 1.25 as a current number for Disney. If the average is 1.15 and Disney's operating leverage statistic is 1.25, it has more fixed costs than the typical entertainment company, right? What does that mean? Its beta should probably be a little higher than the typical entertainment company. I'm not going to get carried away because the difference between the 1.25 and 1.15 is so small that it might be pure statistical noise. But if the number for your company is 2.5 and the average for the sector is zero point 0.8, you have a company with much more in fixed costs. If your number is zero point 0.8 and the average for the sector is 2.5, very different cost structure. Try this out with Airbnb and the rest of the hospitality business. The rest of the hospitality business is hotels with a lot of fixed costs. Airbnb is a technology company, it's a platform. In 2020, they laid off 80% of their employees, brought their costs down because they didn't have the revenues. Marriott couldn't do that. So, unless you have a company that's an outlier, I wouldn't get too carried away, but at least you have a statistic you can track over time to see what's happening to my cost structure. So, what business you're in matters, whether it's discretionary or non discretionary. What your fixed costs are matter because they drive your beta. The third and final determinant of betas is how much have you borrowed. Why does it matter? Because when you borrow money, you create a fixed cost you did not have until you borrowed the money, which is interest expenses. When you have interest expenses, if you look at equity investors, in good times you make a lot more money, but in bad times you lose a lot more money. It just magnifies what happens to equity. And with financial leverage, we have a statistic we can use, we can measure to see how much debt a company has taken on. To the extent that accountants tell us what's debt on the balance sheet, we come back and clean up for it. And we know what the equity in a company is. We can look at the debt to equity ratio for your company. An intuitive way of thinking about this statistic is it tells me for every dollar of equity, how much did I borrow? This statistic should be in market value terms because we're looking at a beta, which is a market number. So if you have $1 billion in equity and $500 million in debt, your debt to equity ratio is 50%. I'm going to now kind of confuse you by breaking beta down into two variants. The first is I'm going to call it a levered beta. Okay, this is the beta that reflects not just the business you're in, but how much you've taken in debt. But I'm going to create a second version of beta that I'm going to call an unlevered beta. An unlevered beta is the beta of the business you're in and the fixed cost you have. So if you start with the unlevered beta and you know what your debt to equity ratio is, you can estimate what the levered beta, the beta for your equity, will be by bringing in the effective debt. You're saying, what's this 1 minus t doing in there? What's it doing in there? Why am I multiplying the amount of debt you have by 1 minus t? Because the government kind of puts its hand over your shoulder saying, when you borrow money, we'll be on your side because we let you claim it. So it makes your fixed costs less painful because they are tax deductible. It's called the Hamada equation for beta. You'll see variants of this equation if you worked at a bank, maybe without the 1 minus t, and they're all okay because essentially you're trying to adjust the beta for leverage. I'm going to stick with this one because I know it's the one that I find most consistent with the rest of what we're going to do. But essentially, the levered beta captures the beta you will see as an equity investor. And that will reflect not just the riskiness of the business, but how much debt you chose to take on. But when we ran a regression and we got a beta, it just said beta, right? Is a regression beta a levered beta or an unlevered beta? Constantine, what makes it levered though? Because,
Is
but all I did in the regression was run regressions of returns in the stock against returns in a market index, right? Okay. When you run the regression, you use returns on a stock, and you have a company with a lot of debt, the returns on the stock are going to be more volatile. It's kind of sneaks in there, right? You didn't even know it was in there. A regression beta is always a levered beta. In fact, I can almost guarantee you that when you see a beta from a service or beta from a regression, it's always a levered beta. Unlevering requires that you work at it. The regression beta we got for Disney was 1.25. I know we had lots of questions about it, but let's start with that. It's a levered beta. But let's step back and think about what leverage is built into that beta. To get that beta, I ran a regression over the last 5 years, or 2009 through 2013. The leverage that's built into the beta is not the debt to equity ratio today, but the average debt to equity ratio that Disney had over those 5 years. So let's say that average was 19.44%. And that's observable, right? You can look at the debt and the equity each year, the average debt to equity. So let me emphasize again, it's not so if you went out and borrowed $5 billion yesterday, your regression beta will not reflect it because the average debt to equity ratio during the regression. I'm going to do something that's going to look like I'm creating more work, but there's a reason I'm going to do this. I'm going to take my regression beta and I'm going to unlever it. Sounds fancy, but when I unlever it, I'm taking out the effect of debt from this. So 1.25 is my levered beta, it's a regression beta. 19.44% is my debt to equity. The tax rate I'm using is a 36.1% tax rate, which in 2013 was the marginal tax rate that Disney faced. We'll come back and deal with this question of marginal tax rate. What does it measure a little later in the class? But if you work through the math, you end up with an unlevered beta 1.11. Again, people go through this exercise mechanically, so I want to put some flesh on this number again. Have you ever seen Jeopardy, the show? It's a very strange show. It took me a while to get used to. Because the way the show works is I give you an answer, and you got to guess the question. You ready? We're going to play some Jeopardy. If the answer is 1.11, what is the question to which it is an answer to? And so what's the unlevered beta? I want something a little deeper than that, right? What is the question that I'm answering you when I say that with that 1.1? Yes. One question you could ask is, what is the risk of the business? Not the risk of the equity. What's the risk of the business? The answer would be 1.11. Any other questions to which it's the answer? Could Disney have run this business entirely as an equity funded company? It's a choice companies have, right? So the second question you could ask is, if Disney had been an all equity funded company all the way through, what would its beta be? It wouldn't be 1.25, it would be 1.11. The unlevered beta kind of latches on to the risk of the business. And if you think about Bulgari versus Quest, here's where it's going to show up. The unlevered beta for Bulgari will still be high because your core business is risky. The unlevered beta for Quest is going to be much, much lower because the core business is pretty safe. They've just chosen to take on a lot of debt. There's one beta I didn't quite touch, which was Altria. Altria, of course, is Philip Morris. I don't know why companies even change their names. I do know the name gets toxic. You think so. They think changing from Philip Morris to Altria takes away the taint of cigarettes. But why does Altria have such a low beta? Hey, if you want a really low beta, addictive. I mean, don't pick on Altria. If Credit Suisse could addict you to structured products, would they? Of course they would. It's every company's dream to addict you to whatever the product is. It works for Altria. We pick on them because it worked for them. It doesn't work for you, but it's a driver of low betas. Right? So, two questions which, and there's another reason why I unlevered the beta. Can companies change their mind on debt and increase their debt ratio or lower their debt ratio? Absolutely, right? And now I have a basis for telling you what the beta will be if you choose a different debt ratio. So what I've done here is I've taken the debt to capital, again, all in market value terms, from zero debt. Zero debt, your unlevered beta is your levered beta, 1.11. And then I've tried different debt ratios, 10% debt, 20% debt, 30% debt, 40% debt, same business, same project, same theme park, same movies. All I'm changing is how much of my capital comes from debt. Let's start with the obvious effect. As I borrow money, my equity beta, the levered beta, gets higher. Not because the business is getting riskier, but because I've magnified the effect of it. So think of debt as a magnifying glass. Basically, it takes whatever risk you have as a company and magnifies it. And as my debt to cap goes up, my debt to equity goes up. And getting from debt to cap to debt to equity is a very simple exercise. If your debt to cap ratio is 20%, you have debt of 20, equity of 80. 20 divided by 80 is 25%. Debt to cap is 30%, debt is 30, equity is 70, 30 by 70 is 42.86%. So if you give me the first column, the second column falls out of it. The debt to equity is what I use to lever the beta. And as I get to 90% debt, or 900% debt to equity, take a look at what happens to Disney's beta. You're saying Disney with a beta of 7.51, you can take any company and make its beta 7, 8, or 9 if you borrow enough money. You're saying who'd be crazy enough to do it? You know what the typical debt to cap ratio in a leveraged buyout is? 80% debt, 85, pushing to 90%. So if you do a leverage buyout, I don't care if you're KKR or Blackstone, you've done all your homework, you got right after you've done the leverage buyout, you're incredibly exposed, right? And the analogy I would offer, it's like building a home right on the ocean front in a Caribbean island where hurricanes come through regularly, and you have no windows put in yet. Right after you buy the home, you're just going to frantically get the windows in, hoping and praying that a hurricane doesn't hit in the meantime. Do you see the analogy here? You do a leverage buyout, even if you've done all of your homework, you've done this right. Right after the LBO, you're incredibly exposed. And if there's a recession that hits you, I don't care how well you did your homework, it's not going to make it. But if you have time, what's your first priority right after the leverage buyout? What do you have to do? Don't pick projects, don't go out. Your first focus is to bring the debt down. By doing what? By selling assets, by using cash, whatever you can, because you can't survive as a business with a debt to equity ratio of 80 or 90% if you're any normal business. The only businesses that have debt ratios that high that survive tend to be either utilities or banks. With utilities, you can see why, right? Why can they survive with debt ratios that high? And the unlevered beta is close to zero. It's not just they're a monopoly, but they sell a product you can't live without, right? Power, water. Their unlevered betas are so small that they can go to a 90% debt ratio and the levered beta is still around 1. Why do banks survive with a lot of debt? Because the core business, banking business, is actually a very safe business. You take in deposits, you lend it out. If you had an all equity funded bank, its beta would be like 0.15, zero 0.2. So historically, what have banks done? They've been able to borrow money and still get away with it. We'll talk about this later, but what have banks increasingly tried to do in the last 40 years, partly drawn by greed and partly by the fact that of FOMO and being left out? They no longer want to do old fashioned banking. They want to do investment banking, they want to trade. I understand. But if you do that, what should you do to your debt ratio as you embark on these riskier and riskier endeavors? You have to bring it down. But they didn't. Why? For the same reason the telecom companies don't. Then you have crises like 2000. Say, what the heck happened? It's not a question of what the heck happened. Why did it take so long to happen? Because when you take risky business and you borrow them, that's effectively what you're doing. So you'll see this again when we talk about financing mix. If you want to minimize your cost of equity, it's simple. Don't borrow money. But if you want to talk about cost of capital, this is going to become an ingredient into that process to say what's the right mix of debt and equity. Because it'll tell you what happens to your cost of equity as you borrow more money. So get comfortable with that levering, unlevering, if you have trouble with the order of operations, get over that. No, because it's again a struggle if you haven't been around numbers for a while. Go through. My wife teaches fifth grade. She struggles with her kids getting the order of operations right. But it's something you forget if you don't work with numbers. And if you get the order of operations wrong on that levered, unlevered beta equation, God help you, you're going to get strange looking numbers. So work through a few by hand to make sure you get this right. Which brings me to way I'm going to get around regression betas. Because by now you can see I'm a skeptic on regression betas. I don't like that one regression, one slice of history. You can play games with it. So here's where a property that betas have that is very useful comes into play. Betas are always weighted averages. Weighted by what? How much money you've invested in each asset you have. So let's take a simple example. Let's say you run the Fidelity Magellan Fund. Robert Stansky used to run the fund, was a Stern MBA from the 1970s. Fidelity Magellan Fund is one of the largest mutual funds in the world, invested what used to be young companies, but now increasingly in kind of tech companies and growth companies. There's 150 companies in its portfolio. You know the beta for the fund, for the Fidelity Magellan Fund will be? A weighted average of the 150 beta is weighted by how much money it has in each one. Each of you has a portfolio. I don't know how big the portfolio is. I want to ask you. It's personal. But take a look at your portfolio. Take a look at what it's invested in. Each of those investments has a beta. So maybe you're in 5 mutual funds. You have betas for each fund. You're going to take a weighted average. Maybe you have a lot of money in cash, in which case a beta of 0. The beta for a portfolio is a weighted average of the betas of the investments that go into the portfolio. So if this were an investments class, that's the route we're going to go. But this is a corporate finance class. We're talking about businesses or companies. And I'm going to use the same principle. The beta for a company should be the weighted average of the businesses that that company is in. I told you GE was in 26 different businesses. If I could figure out a way to give you the beta for each of those businesses, the beta for GE is going to be a weighted average of those 26 businesses. When you have a merger, 2 companies coming together, it's going to create a combined company. The beta for the combined company will be a weighted average of the betas of the 2 companies involved in the merger. So we're going to build on this principle by starting with a merger. And I'm going to go back in time to 1996 when Michael Eisner decided to buy Cap Cities to make Disney a bigger entertainment company. So at the time of the acquisition, Disney had about $3.2 billion in debt and a market value of equity of $31.1 billion. Cap Cities had about $615 million in debt and a market value of equity of $18.5 billion. If you add the debt plus equity, you get the value of the entire firm. And Disney's total value is $34.3 billion. Cap City's total value is $19 billion. You're saying, why do you care about the values? What did we say the beta for the combined firm will be? A weighted average, right? So it's good to know that Disney is a bigger firm, Cap City is the smaller, the weighted average is going to reflect those weights. They were both publicly traded. The beta for Disney, the regression beta is 1.15, the equity beta, and Cap City's equity beta is 0.95. Again, what do we say those regression betas are? Levered or unlevered? They're levered betas reflecting the debt to equity of the 2 companies. And you can see the debt to equity for Disney is about 10%, the debt to equity for Cap Cities is about 3%. Now, I'm cheating a little bit because I'm supposed to use the average debt to equity ratio over the last 2 or 5 years. I'm going to stay with the debt to equity now and act like it's a debt to equity over the period. So here's what we're going to try to do. We know these 2 companies are going to merge and you're going to have one big Disney, right? Cap Cities being part of it. And we're going to try to estimate the beta for the combined company. So before we embark on the numbers, given the betas, what do you think the beta for the combined firm will be? At least let's get a sense of direction. Will Disney's beta decrease from 1.15 or increase after the acquisition? Because you're buying a company with a lower beta, it should decrease unless Disney does what? It funds the acquisition with debt. And this becomes the wild card, right? Because you could do this acquisition and end up with a higher beta if you take on a lot of debt. So because debt is a wild card, what I'm going to do first is estimate what the beta will be for the combined company without even thinking about debt, and then bring in debt so that it can keep the 2 processes separate. It's a good idea because many of the quizzes, this is a question you'd see where the company does something that changes the business and it changes its debt to equity ratio. Keep the 2 separate. First work out what the beta will be for the business and then bring in the debt effect. So let's start with the first and look at the beta for the combined company using just unlevered betas. Remember, that's the beta of the business. The unlevered beta for Disney is 1.08. The unlevered beta for Cap Cities is 0.93. So I'm doing exactly what I did with the Disney regression beta of unlevering the two betas. So I know the unlevered beta for the two companies. Here's a rule that I think will take a little while to stick, but if you keep at it, it'll stick. When you work with unlevered betas, the weights you should use should be the weights for the entire business, the value of the entire business. The values of the two businesses, 34,286 and 19,115, give me weights of about two-thirds and one-third. And you work through the unlevered beta for the combined company is 1.026. Disney is buying a safer business. Its unlevered beta decreases because it's buying a safer business. So now I know what the unlevered beta for the combined company will be. Now, to do this acquisition, Disney's got to come up with $18.5 billion, right? Because that's what Cap Cities is worth. Let's work through some of the ways it could have done this. Could it have issued all equity? Yeah. And usually this will take the form of giving shares. So if you're doing an acquisition where you're paying with shares, like they did for, for Lucasfilms or with Pixar, you could issue 18.5 million. Could they borrow the entire 18.5 billion? So think of those as the limiting cases: all equity, all debt. Disney actually borrowed 10 billion and used 8.5 billion of their own equity. What happens to the 18.5 billion Cap Cities equity? You're going to have a bonfire right after the acquisition. It's going to disappear because there will be no Cap Cities. So I'm going to estimate the beta with that actual debt ratio of the actual debt mix of 10 billion in debt. 18. So let's first work out how much debt Disney will have after the acquisition. Incidentally, they took on, or the Cap Cities debt, so that doesn't always have to be the case. In this case, they took the 615 million. But then if you add on the 10 billion, you end up with 13.8 billion in debt. So after the deal, if they borrow 10 billion, the debt will go up to 13.8 billion. The equity will be the 31.1 billion plus the 8.5 billion in equity they have to issue. So this isn't Cap Cities equity, this is their equity. The equity will become 39.6 billion. The debt to equity ratio would be 34.82%. And this is why doing the first step helps. You know what the unlevered beta for the combined firm will be. Gives me a levered beta 1.25. Don't, because that is equal to the regression beta, don't create some strange rule in your head that if you do an acquisition, your beta will move towards the regression beta. It's pure coincidence. I actually also looked at what would happen if they used all equity for the deal. Remember, that's an option. They didn't take this option. If they had, the debt to equity ratio would have actually decreased to 7.66% because they used all equity. And the levered beta would be 1.08. I'm going to give you a task that I would like you to try, and this is good exercise for the quiz. If Disney had used 18.5 billion in debt to fund this acquisition, rather than the two scenarios we look at, I want you to estimate what the levered beta would have been after the deal. You kind of know which direction it goes, but I want you to work through the mechanics. So try 18.5 billion debt, work out the total debt, work out the equity, come up with the debt to equity ratio. I will send you the solution in the email I send later today after the class. But take an extra 5 minutes after class, work it through, because it'll get you more comfortable with the notion of how an acquisition gets funded can affect the beta for the company after the deal. But separate out that unlevered beta effect from the leverage effect, because they both come into play. But if you try to mix them up, messy things end up happening. So always work through the unlevered beta first before you look at the effect on debt and equity. Any questions? Okay, so let's end on that page. When we start back on Wednesday, we will continue with weighted average betas.